Today it's time to talk about taxes. I know. You're like, Brian, the whole point of investing with my retirement account is to stay tax-free, and we're certainly trying to do that. And while it is true that certain accounts like a solo 401k or an EQRP maintain tax-free status, a self-directed IRA does incur some taxes when used for passive investing. We're here to make sure that we can get those taxes to the absolute minimum. So let's simplify this by breaking down two related key concepts: unrelated debt-financed income, otherwise known as UDFI, and unrelated business income tax, otherwise known as UBIT. UDFI refers to income generated from borrowed funds that are external to your retirement account. Said another way, it's basically money brought in from the outside, so any income generated using debt that is not directly from your retirement account will incur a bit of tax. The initial purpose of the IRA, when it was created way back in the 70s, was to save your tax-deferred income for the future. So when you borrow money from a bank or a lender, in this scenario, your tax-deferred capital, it actually benefits from taxable dollars. And the IRS, they're fine with that. They just require that you pay taxes on the income that is generated in this scenario. In this example, the behavior is UDFI, and the tax you pay on UDFI is known as UBIT. So we'll just walk through an illustration here. To illustrate this point, let's imagine you bought an apartment complex and you made a 25% down payment, and the bank loaned you the remaining 75%. The 25% equity is your own equity, and any income from this portion is completely tax-free. However, the 75% that is leveraged outside of your IRA is subject to UDFI and consequently UBIT. The silver lining here is that this portion of income can utilize its own share of losses, such as depreciation, operating and interest expenses, or any other property-related expense or loss. And that helps basically offset UDFI and to minimize the taxes that you need to pay year over year. For those who would much prefer to invest in a solo K or an EQRP but don't currently have that opportunity because they're not actively earning income in their own business, the only option that they currently have is a self-directed IRA. One unique thing that I would implore you to do to get started with self-directing is go ahead and just open up that self-directed IRA, and you can invest through that process. And we've had a litany of our investors over time throughout the holding period of that investment, once they've had the opportunity over the first couple of few years to establish self-employment by creating a side business, they could then take that self-directed IRA and roll it over to a solo 401k or an EQRP. Again, you could always invest through a self-directed IRA. It would have a little bit of that UDFI or UBIT tax, but oftentimes one of the more advanced strategies that some investors do is once that self-directed IRA is open and up and running for a couple years, prior to having maybe a liquidity event in that investment, they would transfer the self-directed IRA over to a solo 401k or an EQRP to try to ensure that any of those additional gains deriving from the debt are actually not taxed. So just a little bit of an additional nugget, advanced information for you, should you choose to go down that path in an effort to try to help you mitigate UDFI and UBIT as you progress. Understanding these tax implications, it's just crucial to making the most informed decisions that you can for you and your family. Here at Sunrise Capital Investors, we're always committed to helping you navigate these complexities and maximize your investing potential. So stay tuned for our next video where we'll delve deeper into the world of passive investing and how it can help you generate legacy wealth for you and your family.